Okay, thank you for tuning in to another edition of the Black Ops Trading tutorial. In our last talk, we discussed the introduction to the Armageddon spreadsheet. Today, what I want to do is go over some trading tactics. There have been a lot of questions as far as how do you select securities and money management and all that stuff, and how much to trade. So we're going to look at that. Okay, first of all, what you want to remember is that when you're trading equities, okay, when you're trading ETFs and including inverse ETFs, what you want to keep in mind is, depending on the size of your account and your familiarity with trading, if you're a new trader, rookie beginner, you want to trade small, okay? You want to trade small size. Trading small size also allows you to leg into positions and to add to positions as the market moves in your favor. And it also allows you a nice ability to leap the huge learning curve that comes with trading, because regardless of how much I teach you and all the books and stuff that you've received, experience is the biggest thing. I also encourage new traders to try using simulators. I know ThinkorSwim has one. You hear me talk about ThinkorSwim a lot because I really like their platform, and overall they're a really good firm through TD Ameritrade. I don't get paid for endorsing them or anything like that. It's just that it's where I have my account, where most of my clients have their accounts, and I just had a very good overall experience in working with TD Ameritrade ThinkorSwim. But there are other good firms out there too that I've traded with, such as INTERACTIVEBROKERS and Fidelity. They're very good. INTERACTIVEBROKERS is like TD Ameritrade ThinkorSwim because you can trade futures, Forex, and equities all in one account. At the Fidelity, you can only trade equities such as ETFs. There's no futures or Forex trading at Fidelity. Okay, so there you have it. As far as trading platforms are concerned, my favorite is the TD Ameritrade ThinkorSwim, because that platform to me it has everything that I need in it. Okay, moving right along. The current upgrades in the sheet. I want to begin by, first of all, prefacing what I'm about to say based on an enormous amount of research that I've been doing over these past several weeks. There has been a lot of chatter on Wall Street as far as a lot of old timers being, what's the word I'm looking for? Angry, if you will, for lack of a better term, because they're unable to trade and have access to the market the way that they're accustomed to. Now, in the beginning, I didn't really believe that, and high frequency trading got a lot of bad flack and stuff like that. The truth of the matter is, high frequency trading does provide a lot of liquidity in the markets. Okay, that's a plus. But the reality is that the dynamics of the overall markets, and I mean Forex, I mean futures, commodities, I mean stocks, ETFs, doesn't matter. High frequency trading has changed the overall dynamic of the markets and has made the markets less efficient overall. That is a sad truth. Robots and computers have taken over the markets, and for lack of a better way of saying it, they really have destroyed the markets. Markets don't trend like they used to. You can't get good execution like you used to. There's a lot of gaps, gap on the opens, even gaps on the close. There's intraday trading gaps where the market will be nice and quiet and smooth, and then all of a sudden a burst of activity causes the market to gap and skip. You can't get good fills on stop limits anymore. Most of the time, 99.9% of the time, you get no fills whatsoever. The market just trades through your price, maybe fill maybe 3 or 4 people at the price that you want it to, and everyone else is just out of luck, and the markets just jump and skip. That is not normal price action. There is something wrong with that, especially with electronic trading. electronic trading is supposed to make the market a lot more efficient, such as the NASDAQ level 1, 2, 3 and the Globex trading and things like that. Those are supposed to help in the routing and the order flow. It's supposed to match everybody on a first come first serve basis. But what's happening is the high frequency trading is starting to make the markets extremely erratic and just insanely crazy. That's not a good thing. All right, I don't care how you want to slice it. It's not healthy. It's not a good thing for the markets overall. Another problem that we have noticed is that trend following, okay, for a long time has worked and was the only way to really make long-term consistent profits in the market. Well, because of the introduction of the rise of the machine, we now have that not being the case anymore. Instead of markets trending now, you may get a trend that only lasts for a week or 2 weeks tops, and that's it. Or an intraday phenomenon, and then that's it. It's just crazy. Markets are becoming less and less trendy and more consolidated and erratic, with huge volatility and large, enormous bars and spikes and spike reversals and spike head fake reversals, and just totally destroying the overall order flow and the natural flow of the markets. So in essence, that sucks. Okay, now let me explain what that is really going to mean. Okay, what it means is that a lot of hedge funds since 2008 have closed shop, because not all of the large hedge funds were cheaters. There were some really good funds with really good track records who were trend followers. They bought equities when they were in an uptrend, and when those trends broke, instead of selling short, a lot of them would go into cash. Some of them would hi. Oh, okay, hold on. So what will happen is a lot of them would be able to be on the sidelines and then wait for the trends to come back, and it wouldn't matter, you know. But what has happened is that now, when they started making inverse ETFs and stuff, a lot of them would get on board with the inverse ETFs, but then they wouldn't perform like they would when you held them for an extended period of time. They became more like short-term trading, swing trading, and day trading instruments. And a lot of these hedge funds and mutual funds just really couldn't get down with that. That was too short of a time frame for them. So a lot of them just realized that their methodologies became obsolete, and they just couldn't make money anymore. So they just closed up shop. And that's sad and unfortunate, because that's liquidity that's leaving the market. So what this means is that if you want to stay competitive now and you want to maintain a consistent strategy, you're going to have to remain ahead of the markets. In other words, it's a battle against the machines. It's a battle of algorithms. Another messed up thing is that for the most part in systems trading and strategy trading, if enough people are doing the same thing, it kind of renders the strategy invalid. There's been a lot of debate back and forth about that, but for the most part, in today's market, it's showing itself to be a self-fulfilling prophecy. If everybody's using the Bollinger Bands, then how often is the Bollinger Bands gonna help you out? It's not. Okay, I know you hear my son in the background. He wants me to remind you all that not only has a lot of technical indicators and systems become obsolete, but that the only way to really trade and be ahead of the curve and maintain profitability now is to have matching or greater algorithmic response in the offensive than to use traditional means. That is the only way you're going to be able to consistently beat the street, so to say. It's one of the reasons why I've been able to do what I do and be successful at it, such as being able to call the top in silver, call a reversal bottom in the equity markets, and the corresponding top of those markets, and that's what we do. So anyway, let's jump into the sheet, and we're going to get into some trading tactics that you can use right away. All right. As you know, you have your pulse wave signals here, okay, primary pulse wave signals. And a note to those who are familiar with the sheet: remember, these new pulse wave signals are no longer aggressive. All right, these are actually conservative, and these are more micro bursts than the mega burst signals that you got. So if you see a convergence of signals such as the pulse wave and the key reversal, that just means that what's happening is a convergence in the beginning of what is called a super wave. Super waves have much stronger bursts to the upside and conversely to the downside on sell signals. So you'll be able to ride these a little bit longer and even stack more positions on that. Okay, and now you have your stop loss right here, your initial trailing stop. This trailing stop right here in column M is for your key reversal buy signal and your pulse wave buy trigger. All right, so you have two triggers, okay? Pulse wave, confirmed pulse wave breakout, reversals, okay? This is the stop loss for those two signals, all right? The next signal that you have is the 50-50 day trade signals. On these signals, as we talked about in the last video, you're looking for short profit targets, okay? It doesn't mean that these can't turn into swing trades and positions that you hold overnight or even hold for days and add to. Doesn't mean that at all. What it means is that these are designed to put you on the same side as the big banks. You get to trade alongside Goldman Sachs and JP Morgan and the likes. Those high frequency trading algorithms, even though they trade in hundredths of a second and things like that, and look for short term trades that they hold, maybe a second or two, they still have a convergence of price momentum in them. And there's certain price points in each given day that those stops and things of that nature are going to be held, or a convergence of signals with all the high frequency trading companies out there where they converge, okay? And the only way that they can gain an edge outside of that is to go into the dark pools. But other than that, they still battle one another and crash and collide. And the high frequency trading algorithm here on the 50-50 on the first long trigger signals, whenever you see a HFT, that's the high frequency trading first long signal, that's what that is. That's telling you that you have you're going to have strong bids coming into the market at that point where all the high frequency trading algorithms are going to converge for the day and cause a significant breakout. That's what this is for. This is a very powerful trading tool. I can't stress it enough. The high frequency trading algorithm is extremely powerful, and you'll find that there are days too where you'll have both a long and a short, especially in consolidated markets. What it means is the intraday market is going to be in a narrow range, but it's going to be what is called an expanding narrow range, where the market will expand and you'll be able to capture both long and short sides of the market. So this column here in your 50-50, it gives you which signal or methodology is going to be the bias for the day. So whether it be the high frequency trading or the 50-50. This is the 50-50. On all 50-50s where it tells you, you enter on the second long. On high frequency trading, you enter on the first long. It's just that simple. And then here's the stop for that. Again, I recommend starting off in share lots of 100 shares at a time. Smaller accounts, you can do 25 to 50 shares. There's nothing wrong with that. And then look to add to the positions, okay? There's nothing wrong with that. That's what I would recommend for the equities and ETFs. On the futures, you want to just concentrate on one lots. That's all you need. Just concentrate on one lots, okay? You don't need to get in there and swing for the fences and do 10 and 20 lots. Just do one lot, regardless of the size of your account. You can always stack and add to your positions, okay? We'll get into some more tactics in the next video, but that's all we have time for now. So be encouraged. Remember, take what you can and give nothing back.